Hello students, today we are going to discuss the topic Introduction to Indirect Tax, and under this topic we will study about the GST. So in this chapter we are going to study about the meaning and definition of GST, types of GST, and about its registration process. Also, we will study supply under GST, its valuation, place of supply, and interstate supply. Also, we will going to study about income tax credit system, goods exempted under GST, computation of GST liability. So, the objective of this unit is to focus on various types of taxes under GST. It also aims making you capable to compute the GST liability as per the provisions under GST Act. So, let's start with this chapter. Introduction. GST or Good Service Tax is a indirect tax reform introduced in India to streamline the taxation system and create a unified national market. It replaced a multitude of indirect taxes such as VAT, excise duty, and service tax, with the aim of reducing tax cascading and improving tax compliance. Moving further, let's talk about meaning or definition of GST. It is an indirect tax levied on supply of goods and services in India. GST is a comprehensive and destination based tax system introduced to replace multiple indirect taxes levied by central and state government like VAT, excise duty, service tax, etc. The main objective of GST is to create a unified and simplified tax structure, reduce tax cascading or double taxation, promote ease of doing business, and enhance tax compliance. Now, let's talk about the key features of GST. First is dual GST structure, means it is levied concurrently by the central and state government. It consists of central GST, which is called CGST, levied by central government, and state GST, which is called SGST, levied by the state government. Second, destination based taxation. Under GST, the tax is levied at the point of consumption, that is, where the goods or services are ultimately consumed rather than at the point of origin of goods or services. Third, input tax credit, that is ITC. Its significant features is the seamless flow of input tax credit across the supply chain. Businessmen can claim credit for the GST paid on inputs, capital goods, and services used in the course of business. Fourth feature, threshold exemption. Small businesses with an annual turnover below the prescribed threshold limit are exempted from GST registration and tax liability. Fifth point, composition scheme. Small taxpayers can opt for the composition scheme, which offers a simplified compliance mechanism and lower tax rates based on their turnover. Sixth feature, electronic filing and compliance. GST compliance involves electronic filing of returns, invoices, and payments through the GSTN, that is Goods and Service Tax Network portal, which streamlines the tax administration process and enhances transparency. Seventh feature of GST is multiple tax slabs. GST adopts a multiple rate tax structure with different tax rates for different categories of goods and services such as 0%, 5%, 12%, 18%, and 28%, along with certain goods taxed at higher rates or subject to cess. Eighth feature, integrated GST, that is IGST. It is levied on interstate supplies of goods and services. It is collected by central government and then apportioned between the central and state government. Overall, GST represents a significant reform in India's indirect tax system, aiming to simplify tax compliance, boost economic growth, and create a unified national market. It has a profound impact on business, consumers, and the economy as a whole since its implementation. Now, moving to next topic, types of GST. In India, GST is implemented in several types, each catering to specific transactions and categories of goods and services. The different types of GST in India are as mentioned in this slide. First, second, SGST, third, IGST, fourth, UTGST, and cess. So let's discuss these types one by one. First, Central Goods and Service Tax, that is CGST. CGST is the component of GST collected by central government on the intrastate supply of goods and services. It is governed by the Central Goods and Service Tax Act 2017. The revenue generated from CGST goes to the central government. Now, second type, SGST, State Goods and Service Tax. SGST is the component of GST collected by the state government on the intrastate supply of goods and services. It is governed by the respective state goods and service tax enacted by each state. The revenue generated from SGST goes to the state government where the supply of goods or services takes place. Moving further, next type is integrated goods and service tax, that is IGST. It is levied on interstate supply of goods and services and imports into India. It is collected by the central government and then distributed to the destination state. IGST eliminates the complexities of multiple taxes in interstate transactions by ensuring seamless credit across states. It is governed by the IGST Act 2017. Now, fourth type of GST, UTGST, that is Union Territory Goods and Service Tax. It is the component of GST collected by the Union Territories on the intra-territory supply of goods and services. It is similar to SGST but applicable to Union Territories instead of states. It is governed by the Union Territory Goods and Service Tax Act 2017. Now, fifth type of GST is cess. Cess is an additional tax levied on specific goods and services to fund particular purposes such as education, health, or environmental conservation. Cess are usually applied in addition to regular GST rate. Some examples of cess include the compensation cess on certain luxury and sin goods. So these are the types of GST. Now let's talk about the registration process. The registration process under the GST regime in India is crucial for businesses engaged in supply of goods or services. Here is a detailed overview of the registration process under GST. Let's discuss each point one by one. First, eligibility for GST registration. Any business entity involved in the supply of goods or services with a turnover exceeding the threshold limit specified under GST laws is required to register for GST. Additionally, certain businesses such as interstate suppliers, e-commerce operators, and those liable to pay tax under reverse charge mechanism are mandatory required to register for GST irrespective of turnover. Second, types of GST registration. Regular GST registration is for businesses involved in supply of taxable goods or services. Composition scheme registration. It is available for small businesses with a turnover below the prescribed threshold limit, allowing them to pay tax at a fixed rate based on turnover. Casual taxable person registration for non-resident taxpayers who occasionally undertake transactions liable to GST in India. Non-resident taxable person registration for non-resident individuals or entities making taxable supplies in India. So there are four categories for GST registration like regular GST, composition scheme registration, casual taxable person registration, non-resident taxable person registration. Third point is GST registration process. The GST registration process is primarily conducted online through the GSTN portal. The applicant needs to visit the GST portal and select the new registration option. They need to provide basic details such as PAN number, mobile number, email address to intimate the registration process. Next, fourth point, filing the application form, GST registration form number 1. After initiating the registration process, the applicant needs to fill the GST registration application form, that is GST registration 01, with the required details. The form includes information such as business name, address, types of business, bank account details, goods or services supplied, etc. Fifth point, document submission. Along with the application form, the applicant needs to upload certain supporting documents based on the type of business and registration category. Common documents include PAN card, proof of business ownership, partnership deed, memorandum of association, address proof, bank account details, photograph, etc. are required to be submitted. Sixth point, verification and approval. Once the application is submitted online with all necessary documents, the GSTN portal generates an acknowledgement in the form of application reference number. The application is then processed by GST authorities who may verify the details provided. If the application is found to be complete and accurate, the GST registration certificate is issued electronically. Next, seventh point, time frame for GST registration. GST registration is typically granted within 3 to 7 working days from the date of submission of the application. In case of any discrepancies or additional information required, the applicant may receive communication from the GST department for clarification or documents. Next, eighth point, GSTIN, that is GST identification number. Upon successful registration, the applicant receives a unique 15-digit TIN which serves as their identification for all GST related transactions. Ninth point, post registration compliance. Once registered, business are required to comply with various GST provisions, including filing periodic returns, payment of taxes, maintenance of records, etc. So, these are the 9 steps which are to be taken care for the registration process under GST. Let's recall. First, we have to check the eligibility for GST registration. Then we have to check the type of GST registration which is applicable. Then go for the registration process on the website portal. Then filling the application form. Then submission of documentation. Then verification and approval. Then getting the GSTN number and compliance to be performed after registration. So coming to next heading, supply under GST or valuation of supply under GST. Under the goods of service tax GST regime in India, supply is a key concept that determines the applicability of GST on transactions involved goods and services. The definition and valuation of supply play a crucial role in determining the tax liability under GST. So, moving further, what is meaning of supply? The definition of supply encompasses both taxable and non-taxable transactions, including goods and services, and even transactions without consideration, such as free samples and gifts made in the course of business. Supply includes all forms of supply of goods or services, such as sale, transfer, barter, exchange, license, rental, lease, or disposal, made or agreed to be made for consideration by a person in the course or further of business. Next, valuation of supply. Valuation of supply forms the basis for the calculation of GST liability. The transaction value is generally considered as the basis for valuation subject to certain conditions. Transaction value is the price actually paid or payable for the supply of goods or services where the supplier and recipient are not related and the price is the sole consideration for the supply. Inclusions in transaction value. The transaction value includes all taxes, duties, cess, fees, and charges levied under any law for the time being in force, except GST. Exclusion from transaction value. Discounts, subsidies, incentives, and subsidies provided by supplier to the recipient after the supply of goods or services are deducted from the transaction value. Valuation rules in certain cases, such as related party transaction, barter exchanges, or where the consideration is not fully in money, specific valuation rules are prescribed under GST law to determine the value of supply. Now let's talk about the valuation methods. There are different methods prescribed for valuation of supply under specific circumstances. Some of the common valuation method include open market value, cost plus method, and residual method. In open market value method, the value is based on the open market where the goods or services are readily available. In cost plus method, the value determined by adding a profit margin to the cost of production or supply. Residual method, the value determined using reasonable means consistent with the principles and general provisions of the GST law. Place of supply. Place of supply is a crucial concept under GST. It determines whether a supply is considered an intra-state supply or an interstate supply, which in turn impacts the tax liability and compliance requirements. The place of supply rules under GST are defined to ensure clarity and uniformity in the taxation of transactions involving movement of goods or provision of services. Here is a detailed explanation of the place of supply under GST in India. First, place of supply of goods. For goods, the place of supply is determined based on various scenarios specified under CGST Act 2017. Some key provisions include intra-state supply. If the location of the supplier and the place of supply are in the same state or union territory, it is considered an intra-state supply. In case of interstate supply, if the location of the supplier and the place of supply are in different states of or UT means union territory, it is considered an interstate supply. Next, place of supply of services. The place of supply of services is determined based on specific rules prescribed under CGST Act 2017. The rules vary depending on the nature of services and the location of the supplier and recipient. Some key provisions include point 1, like the place of supply of services shall be the location of the recipient of services except for certain specified services. Various specific rules are provided for determining the place of supply for services such as transportation, telecommunication, banking and financial services, insurance, immovable property, related services, etc. Place of supply of international transactions. For international transactions involving goods or services, special provisions are provided to determine the place of supply. These rules ensure clarity and consistency in taxation for cross-border transactions. Some key provisions in case of import of goods. The place of supply for imported goods is the location of the importer, that is the location where the goods are imported into India. In case of export of goods, the place of supply for exported goods is outside India. In case of import and export of services, the place of supply for services provided in relation to goods or immovable property is the location of the goods or property. For other services, it is based on specific rules depending on the nature of services. Next, impact on taxation and compliance. Determining the place of supply is crucial for determining the applicable tax rates and compliance requirements such as invoicing, filing of returns, and claiming input tax credit. Incorrect determination of the place of supply may lead to tax liabilities, penalties, and compliance issues for taxpayers. Next, documentation and record keeping. Businesses need to maintain proper documentation and records to support their determination of the place of supply. This includes maintaining records of invoices, contracts, agreements, and other relevant documents related to the transaction. Now, coming to next topic, interstate supply. It is defined under Section 7 of Integrated Goods and Service Tax Act 2017. It refers to transactions involving the movement of goods or provisions of services from one state or union territory to another. It is essential to understand the rules and implications of interstate supply under GST for businesses operating across state borders. Interstate supply is defined under Section 7. Any supply of goods or services or both in course of trade or commerce from one state or union territory to another state or union territory is considered an interstate supply. Now, taxation of interstate supply. Interstate supply attracts integrated goods and services tax, which is a component of GST levied by the central government. The IGST rate is generally equals to the sum of central GST and state GST rates applicable to the supply if it had been an interstate supply. The IGST collected on interstate supplies is credited to the account of the destination state or union territory where the goods or services are ultimately consumed. Now, let's talk about place of supply. Determining the place of supply is crucial for identifying whether a supply is interstate or intrastate. The place of supply rules under GST help ascertain the location where the supply is deemed to have occurred, thereby determining the tax liability. In the case of interstate supply, the location of the supplier and the place of supply are in different states or union territories. Now, talk about invoice and documentation. For interstate supply of goods or services, businesses needs to issue a tax invoice containing the details prescribed under the GST law. The invoice must prominently indicate that it is an interstate supply along with the IGST amount charged. Businesses must maintain proper records and documentation to support interstate transactions for compliance and audit purposes. Now, let's talk about registration and compliance. Business engaged in interstate supply are required to obtain GST registration if their turnover exceeds the threshold limit prescribed under the GST law. Registered business need to file monthly or quarterly GST returns depending on their turnover and nature of business. Interstate suppliers must comply with various GST provisions, including invoicing requirements, e-way bill generation for the movement of goods, payment of IGST, and filing of returns. Now, moving further, let's understand about income tax, input tax credit ITC. Businesses engaged in interstate supply are eligible to claim input tax credit on the IGST paid on inward supplies. ITC can be utilized to offset the tax liability on outward supplies and reduce the overall tax burden. Now, next topic is input tax credit system. Interstate supply under the GST regime in India refers to transactions involving the movement of goods or provision of services from one state or union territory to another. It is essential to understand the rules and implications of interstate supply under GST for businesses operating across state borders. Let's understand it further. Any supply of goods or services or both in the course of trade or commerce from one state or union territory to another state or union territory is considered an interstate supply. Interstate supply attracts integrated goods and service tax, which is a component of GST levied by the central government. The IGST rate is generally equal to the sum of the GST and state GST rates applicable to the supply if it had been an intra-state supply. Determining the place of supply is crucial for identifying whether a supply is interstate or intrastate. For interstate supply of goods and services, businesses need to issue a tax invoice containing the details prescribed under the GST law. The invoice must prominently indicate that it is an interstate supply along with the IGST amount charged. Business engaged in interstate supply are required to obtain GST registration if their turnover exceeds the threshold limit prescribed under the GST law. Now, let's talk about various goods exempted under GST. Under the GST regime in India, certain goods are exempted from the levy of GST. Exempted goods are not subject to GST at any stage of the supply chain, from manufacturing to the final consumer. Exempted goods help in reducing the tax burden on essential commodities and specific categories of goods. Here are some categories of goods exempted under GST in India. So, basic necessities, unprocessed food items like fruits, vegetables, grains, cereals, milk, eggs, meat, fish, etc., salt, jaggery, fresh milk, curd, buttermilk, natural honey, and fresh fruits and vegetables, live animals, unprocessed tea leaves, and unbranded flour. If we talk about healthcare medicines, human blood and its components, contraceptives, vaccines and life-saving drugs, medical equipment like hearing aids, pacemakers, and orthopedic appliances. These are exempted under GST. Next, as mentioned here, we talk about educational materials. Goods related to education such as books, newspapers are typically exempted under GST, like printed books, newspapers, journals, educational charts, maps, and globes. Now, if we talk about agriculture inputs, fertilizers, organic manure, and pesticides, agriculture implements and machinery like tractors, threshers, and harvesters. Next category, if we talk textiles, certain textile goods are exempted to support the textile industry and make textile more affordable, like khadi fabric sold through khadi and village industry commission outlets, handloom fabric and handloom products. Now, next category is public transportation, like metro and local train services, passenger bus services provided by state transport corporations. Next, services provided by government or local authorities exempted from GST to avoid double taxation. Services provided by government on local authorities excluding certain specific services. Now, we will talk about computation of GST liability. The computation of GST in India involves several steps depending on whether it's for the supply of goods or services and whether it's an intra-state or interstate transaction. Here is some overview of how GST is computed in India. So first point is identify the nature of supply, determine whether the supply is of goods or services, determine rates and rules apply to goods and services under GST. Next, determine the place of supply. Identify whether the supply is intrastate or interstate or between different states. The place of value rules under GST help ascertain whether the transaction is intrastate or interstate. Now, next point, identify the taxable value. For goods, the taxable value is usually the transaction value. For services, the taxable value may include the consideration charge. Next, determine the applicable GST rate. Different rates available: nil rate, 5% rate, 12% rate, 18% rate, or 28% rate. Check the GST rate schedule and the applicable notification for the specific goods or services being supplied. Next, compute GST amount. Calculate the GST amount based on the taxable value and the available GST rate. For intra-state supplies, compute both CGST and SGST components. For interstate supplies, compute IGST, which is equal to the sum of CGST and SGST. Next point is final invoice amount. Add the GST amount to the taxable value to arrive at the final invoice amount. In the next step, reverse charge mechanism. For certain specified goods or services, the liability to pay GST may be on the recipient instead of the supplier under reverse charge mechanism. In such cases, the recipient needs to calculate and pay the GST directly to the government. Next, maintain records and compliance. Business needs to maintain proper records of GST invoices, input tax credit, and other relevant documents. Timely filing of GST returns and payment of GST dues is essential for compliance with GST regulations. So, the computation of GST liability, hope you have understood. In this, first we have to identify the nature of supply, then we have to determine the place of supply, then identify the taxable value. Now, determine the applicable GST rate. Now, compute the GST amount. After this, final invoice amount, reverse charge mechanism if applicable, and at last, maintain records and compliance for GST suppliers. So, hope you have understood the GST. Let's recall the all slides as a summary. It is an indirect tax levied on supply of goods and services. GST is a comprehensive and destination based tax system introduced to replace multiple indirect taxes levied by central and state government. In GST, we have to determine the place of supply, which is crucial concept because impacts of tax liability and compliance requirements depends upon the place of supply rules, as different rules applicable for different place of supply. Interstate supply also needs to be verified and determined so that essential rules and implications of interstate supply for businesses operating across state borders can be applicable. The computation of GST in India involves several steps which we have discussed depending on whether it's for the supply of goods or services and whether it's an intrastate or interstate transactions. Hope you good understood about the whole GST in a nutshell. Thanks and have a good day.